Few days ago, oil prices dropped 16% in a single day. That's one of the biggest single-day drops in oil price history. And if you saw that headline, you probably thought, okay, crisis over, prices coming down, back to normal. I need you to stop and hear me on this, because that assumption is going to cost a lot of people real money. Gas at your local station is still sitting above $4.10 a gallon. Your grocery bill is still going up. And according to energy analysts, it could take until June just to reroute the cargo ships that were stranded in the Persian Gulf during this conflict, even if the ceasefire holds, which right now nobody can guarantee. Here's the thing nobody tells beginners about money. The headlines and your bank account are on completely different timelines. The headline says relief. Your wallet is still 3 waves behind. My name's Findolax. I break down money stuff in plain English for people who are just starting to figure this out. And today, I want to walk you through exactly what's been happening, why it's not over, and most importantly, the specific moves that will determine whether this period quietly costs you a few $1,000s or whether you come out of it in a better financial position than you started. Let me give you the clearest, simplest version of this. On February 28th, the US and Israel launched airstrikes on Iran. Iran responded by effectively shutting down one of the most important shipping lanes on the planet, a narrow strip of water called the Strait of Hormuz. Here's what you need to know about this place. Imagine all the world's oil as water flowing through a garden hose. 20% of it flows through that one hose. 20% every single day. When Iran started attacking cargo ships and blocking traffic, the hose got nearly pinched shut. Ships stopped going through. At one point, instead of the normal 138 vessels a day transiting that route, there were fewer than two. The International Energy Agency called it the largest energy supply disruption in recorded history, bigger than the 1970s oil crisis that people still talk about today. Oil prices went from around $67 a barrel before the war to over $112 at the peak last week. Then, this week, a 2-week ceasefire was announced. Oil dropped 16%. Great news, right? Here's the catch. Over 800 cargo ships are still stranded in the region right now. Analysts at Energy Aspect say it could take until June just to physically redirect shipping routes. The ceasefire is 2 weeks long, and just hours after it was announced, missiles were still being launched and tankers were still being turned back. Amrita Sen, one of the top energy analysts in the world, said on CNBC this week, it's a complete mess. So yes, some relief may be coming, but the financial shockwaves from 6 weeks of near total closure, those are still very much in motion. Segment 2, Your Kitchen Table Economics. This is the part I really want you to understand, because this is where it gets personal. When oil gets expensive, it doesn't just show up at the gas station. It moves through your entire life in waves, and most people only see the first one. Wave 1, the gas station. You're already feeling this. Gas went from $2.98 a gallon in late February to $4.14 right now, according to AAA. That's nearly a 40% increase in 6 weeks. For the average American household, that's roughly an extra $750 a year at current prices, compared to what you were paying before the war. And here's a small thing that's actually a big thing. Around $4 a gallon is the psychological tipping point where people start changing their behavior, according to AAA research. They drive less, they cancel road trips, they start saying no to things they'd normally say yes to. That ripple in spending is going to show up in a lot of businesses' numbers over the next few months. Now, with the ceasefire, gas prices might dip a bit. GasBuddy estimates it could get back below $4 nationally within 1 to 2 weeks. That's real relief, but don't mistake a dip for the story being over, because Wave 2 is already in the pipes. Wave 2, the grocery store, 30 to 60 days from now. Here's something most people don't think about. Americans spend twice as much on food as they do on gas. Roughly 10% of disposable income goes to groceries. So when the food supply chain gets hit, the impact on your budget is actually bigger than the gas station. You just don't feel it all at once. The U.S. USDA had already predicted food prices would rise 3.6% in 2026 before the war even started. Now, economists across the board are saying that's going to be worse. Why? Because diesel fuel moves everything perishable in this country. You can't warehouse strawberries. You can't stockpile salad while you wait for fuel prices to come down. As one trade expert told CNBC this week, produce has to be shipped and kept refrigerated. As energy prices rise, they're likely to drive higher prices for consumers. The UN's Food and Agricultural Association just reported that global food prices hit a 6-month high in March. Cooking oils, sugar, and meat, the three categories most families lean on to stretch a budget, are all moving up for the same reason. Fuel costs bleed into every stage of getting food from the farm to your fork. Here's the one that surprised me most: plastic packaging. Most food packaging is a petroleum product. As oil got squeezed out of the supply chain, natural gas became more valuable as a substitute, which means the containers your food comes in are also getting more expensive to produce. It's one of those second-order effects nobody mentions, but economists are already flagging. Cornell economist Chris Barrett told Fortune this week that food inflation is coming from every direction at once: fuel, fertilizer, labor shortages, and now an energy shock layered on top.
His quote, "A lot of us had hoped we'd see food inflation decline this year. Instead, it's likely going higher." Wave 3, the fertilizer clock. This one hits in October. This is the wave I haven't heard anyone explain to beginners simply, so let me try. You know how farmers have to decide what to plant in spring, and then they harvest in fall? About 30% of the world's fertilizer normally passes through the Strait of Hormuz. When the strait closed, fertilizer producers halted exports. Urea, one of the most common fertilizers, jumped 50% in price in weeks. In parts of the Midwest, retailers stopped quoting prices entirely because they couldn't guarantee delivery. Now here's why this matters for your October grocery bill. The FAO chief economist said this week that if input costs stay high, farmers may plant less or switch to less fertilizer-intensive crops. Those decisions made this month determine what's on the shelf in fall. You won't see this wave coming. There won't be a news story the week it hits. You'll just notice, standing in the produce aisle in October, that something feels off about the prices and the selection, and it'll trace back to decisions being made on American farms right now. Wave 4, the interest rate freeze, the most expensive wave for your long-term finances, and it's the one beginners almost never hear explained. Before this war, the Federal Reserve was expected to cut interest rates. That would have meant lower mortgage rates, cheaper car loans, some relief on credit card debt. People, maybe you, were building plans around those cuts. The OECD now projects U.S. inflation will rise to 4.2% in 2026, up from 2.6% last year, driven by energy costs running nearly 40% above where forecasters had expected. Former White House official Anthony Scaramucci used the phrase 1970s-style stagflation this week to describe what's developing. The Fed is in a trap that I want to explain simply. Their two jobs are keep prices stable and keep people employed. Right now, cutting rates would make inflation worse. Raising rates would slow the economy and cost jobs, so they're frozen. And the OECD says they're expected to hold rates steady through all of 2026 and into 2027. What that means for you, 30-year mortgage rates are sitting between 6.25% and 6.5%. Credit card APRs are running 21 to 24%, and Americans are collectively carrying $1.27 trillion in credit card debt at those rates. The refinancing window that so many people were waiting for, it just got pushed to at least 2027. Segment 3, the trap most beginners fall into. I want to be honest with you about something. Everything I just described is real, verified, and backed by economists and analysts tracking this daily. But here's the uncomfortable truth. None of that is going to cost you the most money. The thing that costs most beginners the most money right now is the emotional reaction to scary news. Let me paint two pictures of the same person. Same age, same income, same $40,000 in a 401k, same $500 a month going into index funds. Person A sees all of these headlines. The S&P 500 is down roughly 7% from its January high. The Nasdaq is down over 10%. Goldman Sachs just raised their recession
recession probability to 25%. Person A panics, moves money to cash, pauses their contributions. They tell themselves they're being smart. They're waiting for things to calm down. Person B sees the same headlines, does nothing, keeps the same contributions running on autopilot, doesn't open the portfolio app every morning. 5 years from now, and we know this from over a century of market data, Person B's account will likely be dramatically larger, not because they were smarter, because they didn't let fear override their system. After the dot-com crash in 2000, the market dropped 49%. People who stayed in fully recovered and went on to build serious wealth. After March 2020, the fastest 34% crash in history, the market had fully recovered in 5 months and ended the year up 60% from its low. Every single time, the people who stopped investing locked in losses and missed the recovery, and they usually didn't even realize that's what happened. Here's the thing about beginners specifically. You actually have time as your biggest advantage. You're not a hedge fund that needs to produce returns this quarter. You just need to not sabotage yourself when it's scary. Segment 4. What to actually do this week. Okay, concrete stuff. No opinions, just the moves. 1. Move your emergency fund to a high-yield savings account today. Half of Americans can't cover a $1,000 emergency without going into debt. If that car repair lands in the middle of rising grocery bills and higher gas prices, and you don't have cash sitting somewhere accessible, a $900 inconvenience becomes a $900 credit card charge, compounding at 22% for months. High-yield savings accounts are currently paying 4 to 4.2%, 10 times the national average for a regular savings account. With rates frozen, that's genuinely free money you're leaving on the table if you haven't moved it. 2. Attack credit card debt like it's on fire. Paying off a credit card charging 22% is mathematically the same as earning a guaranteed 22% return, tax-free. You cannot buy that anywhere. With inflation rising and rates frozen, every month you carry that balance is a compounding tax on doing nothing. This should be your most urgent financial priority. 3. Do not stop your investment contributions. I know the news looks scary. I know your 401k balance probably looks uncomfortable, but the shares you buy during a downturn are historically among the best performing investments you'll ever own. The worst thing you can do right now is lock in losses by moving to cash, then miss the recovery, then buy back in at higher prices. That's the exact pattern that separates people who build wealth from people who feel like they're always a step behind. Set the contribution, automate it, step away from the app.
4. Audit where your money is going before the waves hit harder. Gas going from $3 to $4 is an extra $30 to $50 a week for a heavy commuter. Over $1,000 a year that wasn't in your budget 2 months ago. Go through your recurring expenses now while you still have breathing room. Cancel one subscription. Meal prep once a week. Renegotiate an insurance policy. None of these are dramatic, but together they create a financial cushion before Wave 2 and Wave 3 land. 5. If you're flying this summer, book now. Jet fuel surged more than 60% during the peak of the conflict. Airlines are already planning for that. Every week you wait on summer bookings is likely money you're giving away. The ceasefire helped, but analysts don't expect fares to normalize quickly. Here's my honest take on where things stand today. The ceasefire is real, and the relief in oil prices is real, but 800 ships are still stranded. The strait still isn't fully open, and the downstream waves, groceries, fertilizer, frozen interest rates, don't move backward just because oil ticked down. The people who come out of this period ahead aren't going to be the ones who made the most dramatic moves. They're going to be the ones who made 5 small, boring decisions: emergency fund, debt, contributions, spending audit, travel, while everyone else was still doom scrolling. You don't need a crystal ball. You just need a simple system that keeps working when you're scared. If this helped you understand what's actually going on, hit like and subscribe. I break this stuff down every week for people who are just starting to figure money out. No jargon, no hype, just the mechanics that actually matter. I'll see you in the next one.